Most people think the stock market moves because of the news, but markets don't move on news alone. They move on how people interpret that news and, most importantly, how they react to it. That reaction is shaped by expectations, positioning, and psychology, and that is where the game theory quietly explains a lot of market behavior. Game theory is simply the study of decision making when outcomes depend on what others do. In the stock market, no one acts in isolation. Every buy or sell decision is influenced by what you think others will do and how quickly they will do it. That is why markets behave less like a calculator and more like a strategic game. Let me make this very practical. Imagine a company is about to announce the earnings. Analysts expect strong numbers. Some traders buy early, believing prices will rise once the results are out. Others start selling into that rise, assuming the good news is already priced in. A third group waits on the sidelines, watching how the first two groups behave. The stock doesn't move simply because earnings are good or bad, but it moves because of who anticipated what, who acted first, and who got trapped on the wrong side of the expectations. That interaction is the game theory playing out in the real time. One of the most useful ideas here is something called as the Nash Equilibrium. The name sounds complex, but the idea is very simple. It describes a situation where buyers and sellers reach a temporary balance. At that point, neither side has a strong reason to act aggressively. In markets, this often appears as consolidation. Prices move sideways, volumes dry up, and volatility drops. What's really happening is that participants are watching each other, waiting for a confirmation. So these equilibrium zones matter because once new information enters the system or conviction builds on the side, the balance breaks. And when it does, price moves tend to be fast and decisive. So now here's a critical shift in thinking that many investors miss. The stock market is not just about fundamentals. It's about expectation versus the reality. A company can report strong earnings and still see its stocks fall because the market expected even better results. On the other hand, a company can deliver average numbers and still rally because expectations were low. Game theory helps you understand this gap. Prices don't respond to facts alone. They respond to how those facts compare to what the crowd had already priced in. So, how do you actually apply this thinking as a trader or investor? The first step is to stop reacting to events and start thinking about the reactions to events. Ask yourself not just what happened, but how the market was positioned before it happened. And the second step is to observe behavior, not just the charts. Fear, greed, hesitation, and overconfidence repeat in cycles, and game theory gives you a framework to recognize these patterns. The third step is to respect periods of indecision. When prices stall, it's not boredom or randomness, it's strategic hesitation where the market is waiting for the clarity. The final piece is understanding how the large players think. Institutions don't chase every price move. They test the levels, observe the reactions, and build positions over time. They wait for the probabilities to shift in their favor before committing the capital. So once you start looking at the market through this lens, price action begins to make more sense. Game theory won't give you exact entry points or price targets, but it trains you to think one move ahead strategically rather than emotionally. And in a market driven by human behavior, that mindset alone puts you at an advantage.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing. The securities are quoted as an example and not as a recommendation.